Okay, welcome back to our exercises. So we're going to go through exercise 2.6. So you should find that in your textbook. On Wiley's, if you haven't found your textbook, which I hope you have already, it's under modules, Wiley plus resources, and view eText. There's a little button in the middle of your screen. So if you have not had a chance to read the questions and try the answers, please pause this video. If you've gone through the notes or the PowerPoints, you should have an idea which one of these to put in. So pause it, try the question, and then we're going to go through it. Okay? That's what we would have done in class, so just put a pause and then put it back on when you're ready. Go straight into it because I've already read the question. So here's the list of the foundational principles for accounting. So remember the three areas: recognition, derecognition, measurement, presentation, and disclosure, and then all the principles we went through, most of which were a review from last year. So for each situation that follows, identify by its number. Well, I'm going to write the word out. The foundational principle that's described. So allocates expenses to revenues in the proper period. Well, when we're matching expenses to revenue, that's the matching principle. Indicates that the market value changes after the purchase are not recorded in the account unless impairment, which is when the value goes below cost, exists. And don't use the revenue recognition principle, because of course some of these involve more than one principle. So this one is going to be historical cost. So market value changes after, that's the key thing. Okay, this one you should all get. Ensures that all relevant financial information is reported. That's the full disclosure principle. Notice the use of relevant. Now, this principle is why plan assets are not reported at liquidation value. And we can't use the historical cost principle, because of course that would explain it. Historical cost would be one of them. What's another one? Well, that one's the going concern, where we specifically mention liquidation value. Now, part E, related to the economic entity principle, where you keep each economic entity separate from the other, it defines the entities that should be consolidated. So this was the one you don't really have to worry about until advanced. This is control. Now, part F indicates that personal and business record keeping should be separately maintained. That's the economic entity. Separates financial information into time periods for reporting purposes. So that one's really saying your business, well, how long does it go on? Well, it could go on for 30 years. Well, can you tell if it's successful till you're actually done with it? But you can't wait 30 years to get a financial statement. So we break the financial information into time periods. And what's that called? Periodicity. I think that's what we're calling it. Sometimes they change the form of the names. Now, this, part H, permits the use of market valuation in certain situations. That was the one that was fair value. So market valuations, that's current. So not historical, it's the opposite to historical cost. Hope that's making sense, and hopefully you're getting most of these right. Okay, part I. Requires the passing of risks and rewards, measurability and collectability before recording the transaction. That is revenue recognition. So notice it's not just when you earn or you do work. Now it's a more formal definition. So risks and rewards are transferred, it can be measured, and we're likely to collect it. Because we'll see in some of the chapters, if we aren't likely to collect it, or we're not sure, we can't record the revenue. And finally, assumes the dollar is the measuring unit. That was our monetary unit principle. Okay, so that was exercise 2.6. And that's the kind of question you're going to see. You might see a matching question, something like that, for this type of material. One type of question. In the next video, I'm going to do exercise 2.13, which is another type of question you might see.